One setup, one session, so reliable that it could replace your 9 to 5. This isn't a random strategy. This is the Asia range model, the signature setup that the most proficient smart money traders use to catch the day's best reversals. If you're tired of setups that never work and blowing accounts, listen up. This system will teach you how to time the market like a professional, drastically improving your win rate and leading you to your first step of quitting your full-time job. So stick with me, grab a pen and notebook, because by the end of this video, you're going to have a step-by-step blueprint with real chart examples on how to trade the Asia range like a pro. Before I show you the Asia range model in action on a real chart, I need to teach you 3 concepts. Skip these and everything else will fall apart. The first core concept that we need to understand is the Asia range. Now, what is it? How do we find it? And most importantly, how do we use this? Now, the Asia range is something known as time-based liquidity. All markets have 3 major sessions in a day: Asia, London, and New York session. Each run at different times, but today we're going to be focused on Asia, which runs from 8 p.m. till 12 a.m. UTC -5. Now, during this session, every market is going to have a session high and a session low. This is going to be the highest point that prices reach within Asia, which is here, and the lowest point that price reached within Asia. Now, think of these as pivot points or liquidity zones, where the market often comes back to these areas, tests them, and then reverses. This is where we're going to frame our trade narrative, also known as our bias. Are we bullish or bearish? If price hits Asia high, we're going to be looking for some form of reversal back to the downside, meaning we're looking for short opportunities. Now, if the market comes back down to Asia low here, we're going to be looking for long opportunities, anticipating the reversal. Now, this is the engine of the Asia range model. We just need to keep this part simple. We sweep the high, we look for shorts. We sweep the low, we look for longs. That's the core of this approach within this system. Next up, we have the IFVG, which is also known as inversion fair value gap. This is when a bearish or bullish gap fail. Now, for those of you that can't identify or don't know what a bearish gap is, it's a 3 candlestick pattern where candle 1 wick low and 3 wick high do not touch or overlap, meaning there's a sell side imbalance in candle number 2, and it sounds fancy, but people and traders use these as resistance, so the market can come back into this level before continuating down. Main reasoning behind it is the market likes to be fair value. For every dollar that someone wants to buy, there needs to be someone willing to sell, and vice versa. So what point does a bearish IFVG and bullish IFVG become valid? Now, in a bullish IFVG sense, it's when price closes back above the bearish fair value gap, which means it's closed back above candle 1 wick low. Soon as that happens, this flips from a resistance into a support level, and we can look to anticipate higher prices because the sellers have failed to resist price lower. On the right hand side is that very example. We see that the market broke back above candlestick 1 wick low, and this now flips into a support level until price closes back down beneath the IFVG, and then we need to delete the whole entire thing as it doesn't keep rotating. It only happens once, the flip from bearish to bullish IFVG or bullish fair value gap to bearish IFVG. We can either take the market on an instant execution here or the retest. So now a bearish example is the complete opposite. This is when the market breaks back beneath a bullish fair value gap. Again, a bullish fair value gap is a 3 candlestick pattern where we have a imbalance in candlestick number 2 because candle 3 wick low and candle 1 wick high don't touch or overlap, meaning we have an inefficient area of price action, and the market likes to use these as support to continue higher. Now, the area of invalidation when it becomes a IFEG is when price breaks back below the bullish fair value gap, now changing this from support to resistance, where we can look to trade the market lower, which we see on this example here to the right. The market broke beneath on this candle, creating the IFEG, flipping the support into resistance. The market traded back into it and then traded to the downsides. And the final core concept here is swing highs and swing lows. These are known as legs in price action. So a swing low is where price stops to move lower and starts to move higher. So we swung low on this downwards movement. And a swing high is where price stops moving higher and starts to move lower, forming that local peak. Now, how we identify these correctly is due to candlestick anatomy, and from a swing low to swing high to begin, it will be represented by a bullish candlestick breaking above the previous candlestick high, confirming the transition from a leg lower into a leg higher. And a swing low to swing high transition is where we break beneath the previous candlestick low and start to swing lower. And I want you guys to practice. You're going to pick it up very fast. It can seem complicated at first. Once you mark it out on your chart, you're going to correctly identify all these key points in price. Now, right hand side, we've actually got a bullish structural market. So these swing highs and swing lows are making higher highs and higher lows. And we see here, we had this leg moving higher. We transitioned into a swing low down to here. Then we transitioned into a swing high on this candlestick again. You just need to track it. This is a very important concept. You skip any of these and the whole system will fall apart. Now, there are variations to swing highs and swing lows. So if you want a full market structure deep dive, let me know. And that's definitely something I can work on. But I need to know that you guys want to see that, and I will post that in the future. Hey, so if you've been finding value so far, I do have a free Discord where we go over trade recaps and pre-market analysis. Here we can see yesterday we had an upside target of Asia London highs, and we did need to see the 15-minute A+ gap be swept before doing so. And going over to the market, here was the price, and we see exactly how it played out. We tagged the 15-minute gap and attacked London and Asia high. So go ahead and join. I'm going to leave the link in the description, and you've got access to me. So speak to you all inside the group. Now, finally, we have our 3-step daily trading framework. Number 1, we're going to identify the Asia range on the 15-minute time frame. Number 2, we're going to wait for a liquidity sweep. And number 3, we're going to wait for our entry model. That is it. 3 simple steps. But first, let's go over our rule sets to prevent anybody blowing up your account. So our first rule is we're going to trade London session only for this system from 2:45 till 4:15 a.m. UTC -5. Our second rule is based on the high or low timing. So if we see the Asia high or low has been swept before London open, the setup will become invalid and we have to come back the next day. Number 3 is max 2 trades a day. This will really stress quality over quantity and just prevent you guys blowing your accounts as long as you risk manage. Number 4, every trade is going to be a 1-to-1 risk to reward for the first 90 days, meaning if you risk $1,000, you're going to look to make $1,000. I want you guys to collect the data on this model, and then you can extend your targets based on your data points. Number 5, you must take the highest time frame inversion inside the active leg. This will come in very handy from what we just discussed in the core concepts. For step number 1, we're going to add this indicator called ICT kill zones and pivots. You're going to go to tradingview.com and in the indicator section type in this, and it's by trade for op. This will just help you identify your session highs and lows correctly. But if you want to do it manually, you can also do that as well. Now here is my actual settings. I've just removed the display text. Next, we have identified the Asia highs and lows. We just want to wait for a liquidity sweep. We don't need to do anything else. If there's no sweep, there's no trade. So if we come back down to Asia low, we're going to look to go long. And if we come higher to Asia high here, we're going to look to go short. Whatever the market wants to do. Now for step 3, this is our entry model where we look for the highest time frame inversion. The time frames that we're going to be looking to find an inversion fair value gap are the 1 minute time frame, the 2 minute time frame, and the 3 minute. We'll be not looking at the 5 minute, 15, 10 minute, no higher time frames. Just stick to these 3. Now to trade the highest time frame inversion, we need to analyze the leg starting on the 1 minute and working our way higher to the 2 minute and finishing off on the 3 minute. Why? Well, we can see here on the 1 minute time frame, we swept Asia low. So we're now looking for an inversion to the upsides, which we do have the potential. There is a bearish gap here. There's another one here and another one here. So if price closes above, that is a inversion fair value gap and a valid signal, unless there is a 2 minute. Now on the 2 minute time frame, it's the same. We can see here on the leg down, there is a bearish fair value gap. Now as soon as you see that, that has to cross off the 1 minute time frame as a potential long entry because there's a 2 minute. And the last thing we want to do is enter a 1 minute IFEG into a 2 minute gap, and it finds resistance and comes all the way back down. Remember, the 2 minute is still open. Yes, there's a 1 minute IFEG, but the 2 minute is stronger and there's a resistance there still. So to avoid getting trapped, we need to check the time frames. Now on the 2 minute, same principle. Can we trade the 2 minute? This will be dependent on the 3. Now on the 3, we can see here we had that swing low down, and we can see there is a bearish fair value gap on the 3 minute. So that now cancels out the 2, the 1, and our entry time frame for this example is the 3 minute time frame. So we're going to wait for an IFEG and we're going to look to take a long position to the upside. So now here we can see the before and after of the 3 minute interval. We started with the bearish gap, we swept Asia low, everything is looking good to take a long. Now on the right hand side, this is where price inverts the gap, meaning we close above the bearish resistance, now flipped into a bullish support level. Now it's very important, the 3 minute must close for this to be a valid IFEG. If there's no closure, there's no entry. So as soon as we see the closure, we can take the instant execution here, stop loss at the most recent swing low, and your target is going to be a 1-to-1 risk to reward for 90 days. You're going to collect your data from the system, see how many it did really run, and refine your edge. Perhaps you target Asia high, the medium of the range, etc. And here is the after example. Here we swept Asia low, remember. Price then inverted the 3 minute IFEG. We used it as support for a little while, with our entry at the instant execution, stops at the swing low, and you would have been out around this swing high. Of course, the market kept running, but for 90 days, you must not break this plan. Most of you are unprofitable, blowing accounts, ruining challenges, blowing failed opportunities just because you can't be patient. I promise you, the slow way is the fast way in trading. So, well done for making it this far. We're now going to jump into some real chart examples so you can see how this framework actually works in real price action. This is where everything that we have learned from legs to fair value gaps and sweeps will finally click in place. Alright, so for the first chart example, we're looking at the price chart of GBP USD on the 15-minute time frame. Now the date is the 19th of November 2025 and our session has just begun. Now the asset is GBP USD, but you can trade this across gold, Nasdaq and other currency pairs, but please make sure to backtest before you go ahead and trade it live. Now we're in session. What's the first thing we want to do? Well, we want to mark out Asia high and Asia low. If you've added the indicator, this will be the blue box and it will label Asia high and Asia low. So that's done for us. Now the next step is we're going to wait for a valid sweep. But coming into the session, you should always ask yourself, has Asia high or Asia low been swept? And if so, was it within London session? Now London session is this red shaded box and I can see Asia has been swept outside of session. So that thesis to be short is now invalidated. We need to make sure that Asia gets swept within London. So let's keep pressing play because Asia low does need to be swept and is intact. Okay. So now we've swept Asia low, we're going to be looking for long positions. Now the long positions will be on our entry timeframes, the 3 minute, 2 minute and 1 minute. So let's scale down from the 15 to the 3 and we'll work our way down. Okay. Now on the 3 minute, remember, we're checking for bearish fair value gaps because we're looking for bearish fair value gaps to fail, giving us a bullish IFEG. Now on the 3 minute, I can see there's a bearish gap here between candle 1, 2, and 3. Now on the 2 minute, is there also a gap? No. 1 minute? No. So in this scenario, it just happens that the highest time frame is also the only time frame. So the 3 minute gets inversed here. We can take the instant execution and target a 1-to-1. Okay, price has now continued lower. So we're just going to follow price. We can even check the 2 minute. Is there any new legs? Yes, there's a 2 minute here, but no bearish gaps in that leg. What about the 1 minute? Okay, the 1 minute has a new leg here. We can see we swung high. Now we have swung low. So this is a new leg separate to this 3 minute downturn. So on the 1 minute, if this does get inverted, that is a potential long entry and we go risk free at the bearish fair value gap. So keep pressing play. Okay, we're taking the low and now we've made a new leg down. So we can delete this old 1 minute bearish gap. And now we can see there's a new bearish 1 minute fair value gap that could be an inversion. If price does break above this level, we can look to long. But what about the 2 minute? Okay, so now we can't take the 1 minute because there's a 2 minute within this leg down. If we extend that across. And what about the 3 minute? Can we take this 2 minute IFEG? No, because there's also a 3 minute fair value gap. So I hope that made sense. That is how we refine our time frames. And we found that there's a 3 minute not IFEG just yet until this candle, but there's a 3 minute bearish gap here between candle 1, 2, and 3. And now it is an IFEG because we've closed above candle 1 wick low. So this turns from a resistance into a support. And what I recommend is taking an instant execution instead of waiting for the retest with your stop loss underneath the swing low. And you target a 1-to-1 risk to reward ratio. And with time, you can extend your targets to London highs. Asia's already been swept now, so that's not a valid draw for price. And we can just see what actually happens next. Boom. In one candle, we hit our 1-to-1 take profit. For 90 days, this is how you're going to be trading. Nothing else. Don't overcomplicate it. Collect the data. Prove to yourself finally that you can follow a system, an edge, and let the numbers play out. You guys sabotage yourself. So let's go and look at example number 2. For example number 2, we're still on GBP USD, starting on the 15-minute time frame. First thing we want to do, Are we in session? Yes, the session has just begun, 2:45. And where is Asia high and Asia low? And have they been swept? Now, coming into our session here, we see that price has swept Asia low, but it was prior to our session beginning. So we're not going to entertain a long thesis. Yes, it's technically London from the Frankfurt Open, but what I like to validate London is from 2:45. So our long thesis has been completed. Now we do have Asia highs resting above price. If we sweep them within London, we can look for shorts displacing back to the downside. Okay, that nearly took out, but not quite. We came very close here. It has to exactly pass Asia highs like we're seeing now. Now we've taken out Asia highs, we can definitely look for some short positions on the lower time frame. So start on the 3-minute and assess what is price doing. Okay, so I can see we've had a huge swing high all the way from down here. So yes, there is clearly bullish gaps within this leg. Remember, before was a bullish example, sorry. Now we're looking for a bearish example back down. So we're looking for bullish gaps to fail that become a bearish IFEG. So there's one here in the 3-minute, 2-minute as well, and the 1-minute also. So we need to keep pressing play on price and just analyze the 1-minute, because on the 3-minute, this whole move is the leg, but the 1-minute might do something like this and provide us an early FEG into a movement down. You do have to keep checking and just scanning between the time frames. You won't miss it. So we're swinging low here on the 1-minute. Okay. No, not quite. We didn't quite inverse that. Okay, so we're now swinging high, swing low, swing high. We now have a new leg that's swinging high here with a gap. If that does get inverted, we can look to short. Okay, there's another one here. And now it has been inversed. But can we take this position? We need to go and check. Is there a 2-minute IFEG or a 3-minute IFEG in this swing low to swing high? Okay, there's not a 2-minute. But there is a 3-minute. So this position you could not take. You have to wait for the 3-minute IFEG to form. So let's keep pressing play on price and wait for price to either use its support or invert it. Okay. So we close beneath the bullish fair value gap from this swing low to swing high. You can now take a instant execution here. We can even press sell. 10,000 contracts, stop loss at the swing high, and we're just going to target a 1-to-1 risk to rewards. With time, you guys can extend that as you find your data point allows you to. So target 1-to-1, stops above the swing high. We can see in this example, okay, TP was hit and we didn't even retrace to use the support as resistance. So that's why we do take the instant execution, just to avoid a potential missed opportunity. And if you did hold, I do think it continues down for a little bit, but you're going to be able to use that and trade that with time. Now, since you made it all the way until the end, you can grab my 7-page free ebook. Just join the link in the description and you're going to see it in my Discord. Download it, let me know your results, and make sure you subscribe so you never miss another video.